you can see as Vega decreases, we would actually make more money as the volatility decreases. Right now it's at 79% for these options. If, in fact, we decreased the volatility, as I'm doing here in this volatility adjustment, by 2%, you can see that already the profit that we would make on a daily basis would increase just slightly. Let me bring that back up to 0 in case you didn't see that. At the current volatility level, you can see that our profit and loss would be a loss of $10 on the day as soon as we put it on this position. But if volatility were to decrease by 2%, now we've only lost $2.86 for this day. So as the price of the stock increases, will also decrease volatility. The reason that we can get this good of a price on these options is because the volatility is at 79%. Now here's another thing to consider. With volatility at 79%, look at the December options. If you go out to the December options, the volatility is only 57%. That's a huge positive skew. Let's say you were interested in owning this stock, but what you really like to do is not only own the stock at $17.50, but have your protection in for a longer period of time. Well, what you could do then is purchase a diagonal. You would purchase a diagonal by selling the July 1750 puts and buying, let's say that we don't want to do September, we want to do the December because it's a lower volatility. The Septembers are still at 71%, but if we go out to December, now our volatility is only 57%. At 57%, we have a positive skew of close to 22% between the July options and the December options. And if we were to do a diagonal on that, our debit would only be 52 cents. We're collecting 66 cents on the sale of these 1750 puts. If the stock goes absolutely nowhere, we make good money based on the sale of these 1750 puts. If the stock declines and we purchase the stock at 1750, well, now we have a long-term option, a December 08 option at $15 as protection. So we get assigned the stock at 1750. We've got 500 shares at 1750, but we have a long-term put, a December of 08 put at $15. Now that's a very attractive scenario. If the stock stays approximately where it is, right around the $19 level, well, this 1750 put will expire worthless and we'll collect the entire $300 that we collected when we sold this put. Now what can we do? Well, pretty soon after these July options expire, we'll have August expiration. Because we own a long-term, a long-dated put at the $15 level in December, now we can also sell the August 1750 puts when they become available. Do you see the power of this? The power is that we have a long-dated option, a December option at the $15 level that we own, which we are long. We can sell against that the July option. We can sell against that the August option. We can even go out to September now and sell another set of options. We can go out to October and sell another set of options. In other words, every single month from July to August, September, October, November, we can sell each month another set of options against the 5 that we own in December. We can even, as we get to the December options, because we own those 15 puts, the 15 level puts for December, we can even then turn that into either a credit spread or a debit spread for the December month. In other words, we still own the $15 puts for December. We can sell again the 1750s to create another the sale of a vertical spread, or we can sell the 1250s and create a debit spread. So we can sell every single month between now and December any of the puts that we want because we are protected by those $15 puts. It turns into a very attractive scenario. So in July, right now, we can sell these for 66 cents. Well, as they get closer to expiration, obviously there's going to be no value left in those if the stock remains the same or goes up slightly. The very next option expiration after these July options expire will be August, because they only put the next month option up after the current month expires. And then they have some longer dated options, as you can see here. So after the July options expire, the August options will be available that you can sell again. Now these 5 December $15 puts are going to cost us approximately $1.21, as you can see here. In order to break even on the purchase of this put, we would have to sell approximately 2 months of options. So if this one we purchased, or we sold this in July and we collected 66 cents for it, if we went out to August and we were able to collect another 66 cents and we kept the entire premium without getting put to stock, we've already covered the cost of our $15 put. That $15 put is absolutely free to us now. So in 2 months we could pay for this one put that we purchased if the stock continues to move up. So that means in September and October we could write another set of puts against those $15 December puts, collecting even more money. Not only are we able to collect an income while we're waiting for our stock to get to 1750, but we have a long-dated option to protect us for any downside risk if we are put to stock. It's a very attractive strategy. Now, you can do this on a single stock or you can do this on multiple stocks. It all depends on how much capital you have to work with. I mentioned Bank of America. Let me ask you a question. Do you think there's a potential for Bank of America to go out of business completely? Think about it. It's either the second or third largest bank in the United States. In fact, it's one of the top banks, the largest banks in the world. How likely is it that they're going to go out of business? Well, not very likely. They're going to be around a long time. If that's the case, then does $27.10 for the price of Bank of America stock look attractive to you? Well, yeah, it might, but let's take a look at a really long-dated chart. Let's go back 20 years. You can see the Bank of America stock has been as low as $12.50 going back to 2001, and even lower than that if we go way, way, way back when it was a much smaller bank. Well, it's had quite a run-up, hasn't it? I mean, if we apply very simple technical analysis to the stock, you can see that it broke through at the $25 level back in the middle of 1998. It hit it, came down, and then broke through back in 2002, and it continued up from there. Now we're getting back close to that $25 level. Well, at that $25 level, that might be a very attractive price for an entry, because in general, what happens is that breakthrough, that area in which the stock broke through, becomes support. Remember, prior resistance usually becomes support.